If your firm only works because 3 people remember how things get done, that is not a moat. That is a bottleneck with a nice margin. For accounting firms first, and tax practitioners right behind them, the scaling problem is not demand. It is that too much of the firm lives in partner inboxes, Excel tabs, and reviewer habit. You can hire around that for a while, but every new client, staff handoff, and filing peak puts more pressure on memory instead of process. Here's the contrarian point. Recording work is not the same as executing knowledge. A checklist in a folder is storage. A rule the system can apply, log, and route for approval is capability. So what is executable institutional memory in plain language? It is the reusable rules, reviewer notes, exception logic, prior decisions, and approvals that sit inside the system and can be supervised by humans. Not hidden in a senior manager's head, not buried in email, not copied from last year's workbook and hoped into accuracy. Think about a tax review. The same issues repeat: missing support, threshold-based flags, state-specific treatment. A reviewer already knows the playbook, but the playbook is rarely encoded where the work happens. The same goes for monthly close and reconciliation in corporate finance. Teams repeat matching logic, exception handling, and approval paths every cycle. If that logic stays manual, speed depends on who is online. And for auditors, the issue shows up in sampling, reconciliation, and evidence collection. The standard is not just automation. It is audit-grade memory, where every AI step has an input, output, reviewer, and trail. This is where most firms get trapped. They buy tools that capture work after the fact. What they need are systems that can act on firm knowledge during the workflow, with humans approving the outcome. Let me make that practical. If a client always triggers the same exception, your system should recognize it, attach the prior rationale, route it to the right reviewer, and log the approval. That is institutional memory executing. The win is not that humans disappear. The win is that humans stop spending their best hours rediscovering firm knowledge that already exists. This is also why connected beats bundled. When accounting, tax, audit, and advisory share identity, portal, workflow history, and decision logs, the firm's memory compounds instead of fragmenting across tools. In maturity terms, this is the move from isolated automation to a cognitive firm. Stage 2 and Stage 3 firms automate tasks. Stage 5 firms encode how the firm thinks, reviews, and decides. Why does this become a moat? Because firm memory that executes is hard to copy. Anyone can hire, fewer firms can turn years of reviewer judgment into supervised workflows that run consistently. It also changes onboarding. New staff do not just get a manual. They get workflows that carry the firm's prior decisions, standard exceptions, and approval patterns right where the work happens. And it changes partner leverage. Partners should spend time on judgment, client strategy, and risk, not answering the same process question for the 5th time in a week. If you want to build this, do not start with a giant transformation deck. Start with one high-volume workflow, one repeated exception pattern, and one approval path that currently depends on memory. Then capture 4 things: the rule, the exception, the reviewer note, the approval record. Once those live inside the workflow, the firm starts learning in a form it can actually execute. The firms that win the next decade will not be the ones with the biggest team sitting on repetitive work. They will be the ones whose institutional memory is visible, supervised, and executable. If you are still scaling on memory in inboxes, spreadsheets, and reviewer habit, pick one workflow and redesign it. Build a firm that does not just remember how it works. Build one that can execute what it knows.